In this video, I'm going to look at pension withdrawal strategies. Specifically, do I access my personal pensions first, say like before ISAs, or last? How do I minimize the tax that I pay in retirement, and how do I maximize the tax-free cash available to me? And I'll put chapters in the video so you can easily get to the part you're interested in. So there have been big changes to pensions following the April 2023 budget, and specifically there's no longer a lifetime allowance, and then also the tax-free cash that you can take is capped at £268,275, which might sound like a lot, but over your lifetime you might actually end up using all that. And then also, most importantly, there's much uncertainty about future changes and whether governments in the future will just reverse all this, whether they'll maybe get rid of the tax-free cash altogether. So for this reason, it's really useful to have a retirement calculator spreadsheet you can just plug your numbers into and get an optimal pension withdrawal strategy. For retirement planning, we've got various pots at our disposal. We've got a general savings account that is taxable. We've got an ISA that's tax-free. There's a state pension. You might be lucky and have a defined benefit pension. There's defined contribution pensions from past employers, or a SIPP that you've invested in yourself, and ideally you should consolidate all these to simplify things. Then you might also have income from like a rental property or a side hustle, and all of these need to be carefully managed within our retirement calculator spreadsheet. Then within retirement planning, we have our investment objectives. So these would be to minimize taxes across income tax, tax on dividends or interest, capital gains tax, inheritance tax. We also want to utilize our personal allowance each year and then maximize the pension tax-free cash, whilst also maximizing the flexibility that we've got in retirement and enjoying ourselves. Sounds like a lot. To summarize all that in terms of some of my rapper friends, according to Jay-Z, we've got 99 problems, but the SIPP ain't one. And according to Eric B. and Rakim, we need to make sure we're paid in full. So a typical pension withdrawal strategy would be to, first of all, utilize your personal allowance, maybe from a state pension, then take money from a general savings account and possibly move money from that GSA into an ISA because the latter is tax-free. Then, if that's exhausted, take money from your ISA, possibly recycling up to £2,880 into a pension if you're under 75. And then lastly, take money from your SIPP because the SIPP has part of it that is tax-free. We want that to grow as much as possible, and the SIPP is not subject to inheritance tax, whereas an ISA is. But then your actual strategy would depend on things like the size of your SIPP, and if it's very large, you might do some different things. Also, your desired expenditure in retirement and whether it's over 50k, so you're in the sort of 40% marginal tax band, and whether you've got large lump sum expenditure you might want to take, and also how scared you are of future tax changes. There are pension drawdown risks, and specifically people who run out of money in retirement tend to lose 50% or more of their pension in the first 3 years from a combination of spending too much tax-free cash lump sum and also stock market declines. So don't be like Biggie Smalls and have mo money, mo problems. So there's two parts to a personal pension. There's a tax-free part that's now capped, and then a part that's taxable as income, where there's no more excess lifetime allowance charges. So in a way, how you might utilize it has partly changed after the April 2023 budget. There's two ways to access your personal pension. The first is known as flexible access drawdown, which essentially involves taking the tax-free cash generally up front, but you could kind of mix and match it like this second chart here. So I'll leave it to you to read the text here if you want to understand a bit more about it. The other way to access your pension is uncrystallised funds pension lump sum, known as UFPLS, and this involves just taking 25% tax-free cash every time you make a withdrawal from your pension, so the cash-free part is spread over the lifetime of the pension. But you can mix and match FAD and UFPLS, and you can also set up FAD to mimic UFPLS by simply taking tax-free cash and then in the same tax year taking 3 times that as taxable income. So we're now getting into the pension withdrawal strategies, and there's 4 examples. The first one I'm calling Barista Fire, where someone has limited wealth but they're willing to take work in their retirement to supplement their income, and such a person might want to avoid taking an income from their pension because that will reduce the pension contribution they can make in the future from £60,000 a year down to £10,000 a year. So they're possibly looking at flexible access drawdown, because with UFPLS, once you've touched it, you've got to pay for it. So I know someone who worked on a few business ideas and ended up pursuing the one that got the most traction. Which one got him out of bed in the morning? Which one were his friends and family most likely to buy from him, so he could get some results and reviews and early sales? And ideally, you can get enough business from your side hustle that you can form a limited company, and that has amazing pension tax breaks. And then you'll be glad that you chose FAD over UFPLS, and you can have a true pension fart, a true pension journey, and get your second wind in life. Example 2, I'm calling Mr. Annuity. So he has reasonable wealth, but he wants the same level of income each year. He has no imagination. He thinks life goals are for losers, and he's risk averse with 40% bonds. So whatever you do, don't become Mr. Annuity. Lead an interesting life in retirement. So he probably withdraw using the guidance I gave earlier and take UFPLS, and that way he will aim to maximize the tax-free cash he can get over like 30 years, say between 57 and 87, and do a slow and steady pension withdrawal. But the antidote to Mr. Annuity, and to stop you being boring, is to retire with 3 years worth of expenditure as a cash buffer, and then you plan in detail what you want to do in those 3 years. And if markets are doing well, you can top slice your pension to either spend the money or top up the cash buffer, and then you can much more easily live with market volatility and just live the sort of life you want. Example 3, I'm calling Moneybags. This person has pension wealth over or near £1 million, and he fears tax changes. So if the tax-free cash doesn't change over time, so it's like the ISA allowance that's just forever 20k, you might be better off taking it sooner rather than later, because inflation's just eroding that money, and then you could move money to an ISA if you don't end up spending it. In this case, you'd be using flexible access drawdown, and you could also potentially gift money to children early if you wanted to avoid inheritance tax. But it's dangerous planning for tax changes that you think will happen in the future. And Pete Matthews of Meaningful Money says that the lifetime allowance is so complicated it probably won't be reintroduced, and I do agree with him. He goes on to say the most likely scenario is that the inheritance tax status of pensions will change, because it is a bit odd that an ISA that's already been taxed is taxed again as part of your estate, whereas a pension that hasn't been taxed is not taxed. And also, Keir Starmer is personally exempt from the lifetime allowance as he has a tax unregistered pension scheme. So for reasons like that, he might be unwilling to actually reintroduce the lifetime allowance when it comes down to it. Final example I'm calling Fun Lover. He wants to do fun things but doesn't want to pay 40% tax. So he's going to have variable expenditure in retirement, including things like house deposits for his children. So initial expenditure, where it's a bit lumpy, would probably come from an ISA to avoid this 40% tax if he's going to spend more than like 50, 60k in retirement. And then in later life, he might take from the SIPP if the ISA has been exhausted, again using flexible access drawdown. And he's got to try to avoid running out of tax-free cash too early. So as an example, if he wants to spend 80k, ISA's all gone, you can take about 67,000 as UF plus from a pension, and that'll utilise all the 20% tax band, and then the rest of the money you take as flexible access drawdown tax-free cash, which would actually end up being over £20,000 because you've got the £13,000 gap, and then you've also got the £7,000 tax bill. And then in doing that, he'd be moving about 61,000 into a drawdown account, and that's kind of providing you're not using trading 212 or free trade, where these cheap pension providers don't really have the facilities available for you to really get the most out of your pension. So you'd be amazed at what you can achieve if you plan properly in retirement. Spend 6 months in Portugal, cruise the South Pacific, study for an MA, start a business venture just to see if it works, fix up an old MG and drive it around the countryside, but you must take action and it's not going to fall into your lap. Other examples of retirement planning, or you could live on the Channel Islands, teach drums part-time and play in a pub band. You could own a rental property in the Caribbean, go sailing, and then when you're away, you rent it out to your fellow sailing people. And I actually know people that do this and they live just amazing lives. So with my retirement calculator spreadsheet, it will tell you the tax you're paying and the marginal tax rate you're facing in retirement, so that you can take action to avoid blips where you might pay 40% income tax, and those tax savings alone more than pay for the spreadsheet. It also calculates the utilization of tax-free cash, so you can make sure you're utilizing all of it over your lifetime. So you can reinvent yourself in retirement, and a financial coach can turn years of procrastination and confusion into a few hours of solid action. Don't be an annuity man stuck in a rut. So my conclusion is you can use UF plus modelling to answer the question, how much money can I spend in retirement? And that will get you an amount you can spend like each year, but then you can use flexible access drawdown to go beyond that and get the most of your tax-free cash and realise your retirement dreams.